Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Accenture stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 195 billion market cap. They're trading at $297 a share, and they have 657 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the free cash flow looks great. It grows each year from 7.6 billion close to 9 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also goes up each year from 5.2 billion to 7 billion. Revenue is the sales for the company, and that grew about 50%. In 2021, it's 44 billion. Now it's 64 billion in the trailing 12 months. So their numbers look really solid. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's 205 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $184 billion. We divide that by 657 million shares. And we get a calculated stock price at $280. They're trading at $297, so they're trading at a 6% premium. It's a small sell according to the model. It looks like my future free cash flow estimates were a bit aggressive. They're a lot higher than the past. And the stock still seems overvalued, but not by much. It has come down a good amount the past couple of weeks. They just released their earnings. There are 67 companies in the same industry as Accenture, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. So in terms of CapEx, they spend about $500 million. IBM spends the most at $1.9 billion. IBM does a lot of manufacturing, so that's why their CapEx is high. Accenture has a really low debt to equity ratio. For every dollar of equity, they only have 10 cents of debt. Much lower than the average. They pay a decent dividend, 1.5%. Look at IBM, nearly 5%. Remember how high IBM stock was in the 80s and 90s? It's really come down a lot. IBM does have the most free cash flow. Accenture is second at 9 billion, much higher than the average of 580 million. Accenture is the largest company in this industry, almost 200 billion market cap. Their price multiples are worse than the median in every category, but better than the average in every category except price to book. Price to book is stock price over book value per share, or market cap over equity. Equity is assets minus liabilities. It's the value of the company according to the balance sheet. They generate the most revenue out of all these companies, a little higher than IBM, and they're still growing. Their 5-year annual revenue growth rate is 9%. IBM is negative 6%. That's why IBM seems like a good value, because their revenue keeps sliding. Look at Globant, 32%. Maybe I should do a video on that company. DXC is also negative 8%, but everybody else is positive. Fiserv, they're growing at 26%. 18 billion revenue, 70 billion market cap. Looks like that could be a good value. Accenture just released their quarterly results. They beat earnings by 3.7%, missed on revenue by 0.5%. Last quarter, they did beat earnings and revenue. Before that, they missed on earnings, beat revenue. And the quarter before that, they beat earnings and revenue. Let's look at their quarterly earnings report. For the fourth quarter, revenue of 16 billion. Their fourth quarter is the quarter that ends 8/31. So this means they completed their 2023 fiscal year. So their 2023 fiscal year revenue of 64.1 billion. That's up 4% from the same period last year. Let's look at their income statement. Revenue of 16 billion. That's for the 3 months ending 8/31/2023. Last year was 15.4 billion. This column is fiscal year 2023, and that's revenue of 64.1 billion. Their cost of revenue is 10.8 billion, 68% of their revenue. Cost of revenue are all the expenses directly related to generating the revenue. Then they have expenses not directly related to generating the revenue, like marketing 1.7 billion, G&A 1.1 billion. So total expenses 14.1 billion, which gives them operating income of 1.9 billion. So their margins are down. Their operating margin 12%. Last year was 15%. For all of 2023, it's 13.7%. They received $104 million of interest on their investments. They paid $17.4 million of interest on their debt. So their net income, $1.4 billion. Net profit margin of 8.8%. The way you calculate net profit margin, it's net income $1.4 billion over revenue. So they convert 8.8% of their revenue into net profit. Last year was 11% because expenses are getting higher with inflation. So lots of companies have lower margins. But eventually they're going to have to raise their prices to adjust for the higher expenses, so they bring their margins back. But it does take time. For some company, they could rebound in a few months, but most companies it takes a year or two, sometimes longer, to get your margins back in place. They have 630 million shares outstanding. Last year was 632 million, so they are lowering their shares. Dividends per share $1.12, up from last year of $1. Here's a further breakdown of their revenue. Of the $16 billion, half is in North America, most of that is in US, some in Canada, $5.3 billion in Europe, $3.1 billion in other countries. Of the $16 billion of revenue, their largest is products, $4.8 billion. Then you have health and public, $3.3 billion. Financial services, a little over $3 billion. Communications, media, and technology, $2.7 billion. And resources, $2.2 billion. Their revenue is nearly split between consulting and managed services, around $8 billion for both. But you could see managed services is up 10%, while consulting is down 2%. So in the past, consulting was a good amount higher. Now they're almost even. Of the $1.9 billion of operating income, $1.1 billion is in North America, and that has the best margins by far, 15%. Europe has pretty weak margins, 8%. Their operating income is $437 million. But that could be the foreign currency translation. So it is possible they're more profitable in Europe, but if they're out of favor with the exchange rate, it can make them look less profitable. But I don't think this is due to exchange rate. Maybe part of it is, but they're just less profitable in Europe. You could see last year, same thing. Their margin was only 10%, much higher in other countries, 17%. Let's take a look at their balance sheet. Current assets of $23 billion, current liabilities of $18 billion. So their current ratio is above 1. Current ratio is current assets over current liabilities. It's how well you can cover your current assets with your current liabilities. Current assets are assets that can be liquidated into cash within 12 months. The most liquid asset is cash. They have $9 billion of cash. That's up from $8 billion last year. Their largest current asset are receivables, how much money other companies owe them when they sell on credit. But their largest asset is goodwill. Goodwill is a premium you pay when you acquire another company. That's close to $16 billion. That's about 1/3 of their total assets. Their largest liability is accrued payroll, $7.5 billion. That means they incurred payroll expenses, but they haven't paid it yet. It's more of a timing thing. Let me know in the comments if you want to explain further. Equity is how profitable the company is historically. $26 billion of equity. Let's look at the statement of cash flows. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. Their net income was $1.4 billion, operating cash flow of $3.4 billion. Because they have nearly $1 billion of non-cash items that are expenses that bring down your net income. Depreciation and amortization, $640 million. Stock-based compensation, $380 million. Then they have $1 billion of changes in working capital. That's why it's $2 billion higher operating cash flow. In their investing section, they spent $180 million in PP&E, property, plant, and equipment. In their financing section, they bought back $1 billion of stock, a lot higher than last year of $600 million. For all of 2023, they bought back $4.3 billion of stock. For the most recent quarter, they paid $700 million of dividends. Let's take a look at the company on Simply Wall Street. Its last price was $297, $186 billion market cap, down 1.5% in the past week, up 10% in the past year. Let's learn a little more about what they do. Accenture is a professional services company that provides strategy and consulting, and they offer their services worldwide. They offer application services including agile transformation, development ops, application modernization, enterprise architecture, software and quality engineering, data management, intelligent automation comprising robotic process automation, natural language processing, and virtual agents. They also offer engineering and R&D digitization, smart connected products, PaaS, product as a service enablement, capital projects, intelligent asset management, digital industrial workforce, and autonomous robotic systems. They were founded in 1951 and they're based in Ireland. Here's a visual of the stock price since 2001. It looks like it IPO'd at $15. It did break through $400 in the beginning of 2022, their highest ever. And it's currently trading around $300. So it's down about 25% from its peak. Simply Wall Street also says the stock is overvalued. Their valuation is $256. 24 analysts priced this stock at $332. They say the stock is undervalued. And the revenue is forecasted to grow each year up to $76 billion by 2026. And here's their historical revenue. Back in 2012, it was $28 billion. It took a decade to double from that $28 billion. It was $60 billion in 2022. Now it's at $64 billion, the highest ever. They were debt-free back in 2012. They did add a little debt during COVID. It was $19 million in February 2020. Then it jumped to $69 million. They brought down their debt to $54 million in 2023. And then they added some debt. It's up to $148 million currently. But when you lay in their equity, it's as if they have no debt. Because look how much higher their equity is than their debt. It's currently $26 billion of equity. And debt is well below $1 billion. It's well below $500 million. It's only $147 million of debt. And if they wanted to, they could pay off all their debt with the cash on their balance sheet. Currently, they have $9 billion of cash. Julie Sweet has been the CEO for 4 years. Her salary is $1.5 million. Total compensation, $34 million. There's only been one insider activity in the past 12 months, a small sell for 750 shares. 79% of the company is held by institutions and 21% by the general public. Vanguard is the biggest shareholder at 9.28%, then BlackRock. JP Morgan owns 1%, Eaton Vance 0.8%, Goldman Sachs 2/3 of 1%. They do employ a lot of people, 259,000 in 2012. It's currently at 733,000. And the ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, London Stock Exchange, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.